What is up, guys? Your boy Dead Son Oblivion back with this week's educational video. Nice trips. Today's educational series video is going to be based on something you hear all the time. What is a bullish market? What is a bearish market? And also, what are some of the ways you can make money on both? So I pulled together a few articles that go over the topics that I want to talk about today. I think it's kind of a cool thing for you guys that are new to trading to understand what this is and what this means for you. So let's get this party started and hop right into it. So jumping right on into this article from the Motley Fool, bull versus bear market. What's the difference? A bull market is occurring when the economy is expanding and a stock market is gaining value, while a bear market is in effect when the economy is shrinking. Let's take a closer look at these two types of markets and their relevance for your investing strategy. What is a bull market? According to the formal definition, a bull market takes effect when the stock prices have broadly increased by at least 20% since the last market downturn. Bull market conditions can last for decades, and many successful investors have bet very wrongly by trying to predict the end of a bull market. The U.S. stock market was in a bullish mode after recovering from the 2008 financial crisis until pandemic-related uncertainty caused the market crash in 2020. The chart below shows that, aside from minor market corrections, a bull market persisted for more than a decade. That's pretty impressive if you look at from right about 2009 all the way up to 2020, and then you see this big drop-off the first time really in a little while there. What is a bear market? A bear market is defined as starting when stock prices broadly decline by 20% and keep trending lower. Bear markets are characterized by people losing their jobs, gross domestic product, GDP declining, and the stock market losing significant value. Bear markets almost never last as long as bull markets and can create buying opportunities for investors. The most recent bear market began following the crash of the housing market in 2008, as made apparent by the chart below. So if we take a look, here's July 2008, boom, bear smash, all the way down to this 903, 750 range, and that's where they're talking about that buying opportunity coming in and the bull market starting to take off again from there. How do bull markets and bear markets differ? If you want to know whether a bull or bear market is in effect, pay attention to these close factors. Stock market performance. Stock prices are rising in a bull market and declining in a bear market. The stock market should be under bullish conditions is consistently gaining value even with some brief market corrections. The stock market under bearish conditions is losing value or holding steady at depressed prices. Here's some of the different types of things you can kind of pay attention to in the stock market. Change in GDP, so if it's rising, then it's a bull market. If it's falling, then it's obviously a bear market. Unemployment rates, if unemployment is going up, then you're going to see the stock market go a little down. If it's going down, then you see the stock market going up. Rate of inflation, there's a big one that's going on now. Price inflation may be a problem when the economy is booming, although inflation during a bear market can still occur. High demand for products and services in bull markets can cause prices to rise, and shrinking demand in bear markets can trigger deflation. Prevailing interest rates. Low interest rates typically accompany bull markets, while high interest rates are associated with bear markets. Low interest rates make it more affordable for businesses to borrow money and grow, while high interest rates tend to slow companies' expansions. So that kind of goes over the differences of what a bull market is versus a bear market. Obviously, bullish markets are just constant increasing in price over time. Bear markets being the opposite, where you're seeing a slight pullback in numbers and a dramatic drop-off, usually 20 to 30%, and can consist for a little while, creating some buying opportunities. How do people make money in either scenario? Because there are some positions that people take that do make some money there, so I want to go over a couple of them. I'm not going to get heavily into depth on them because myself, I don't do these. For the most part, I just stick with long-term. I buy and hold for a while, and then once I feel my profit is where I want it to be, then I sell. There are some other strategies out there that I just want to touch on really quick. So let's start with the bears. Ways to profit in bear markets. A bear market is defined again as its drop of 20% or more in market average. Generally, bear markets occur during economic recessions or depressions while pessimism prevails. But amid the rubble lie opportunities to make money for those who know how to use the right tools. Here are some ways to make profit in a bear market. So you often hear this word shorting, short positions. Taking a short position, also known as short selling, occurs when you borrow shares and then sell them in anticipation that the stock will fall in the future. If it works as planned and the share price drops, you buy those shares up at a lower price to cover the short position and make profit on the difference. For example, if you short ABC stock at $35 per share and the stock falls to $20, you can then buy the shares back at $20 to close out that short position. Your overall profit, therefore, would be about $15 per share. Put options. A put option is the right to sell a stock at a particular strike price until a certain date in the future, called an expiration date. The money you pay for the option is called a premium. A put option increases the value as the underlying stock falls. If the stock falls below the put strike price, you can either exercise the right to sell that stock at a higher strike price or sell the put option for a profit. Ways to make money in a bull market. Again, a bull market meaning the stock market is growing. Long positions. A long position is simply the purchase of a stock or any other security in anticipation that its price will rise. The overall objective is to buy the stock at a low price and sell it for more than you paid. The difference represents your profit. Call options. A call option is the right to buy a stock at a particular price, the strike price, until a specified date, the expiration date. Calls go up in value as the underlying stock price rises. If the stock price rises past the option strike price, the option buyer can exercise the right to buy the stock at a lower strike price and then sell it for a higher price on the open market, thus generating profit. The option buyer can also sell the call option in the open market for a profit, assuming the stock is above the strike price. The bottom line, and I like this line from this, there are many ways to find profit in both bull and bear markets. The key in success is using the tools for each market to their full advantage. As you can see, there are many strategies within the market to make money. There's also a lot of ways to lose money, so be careful with any of those options that I just went over, because you could end up doing something like a short sell and it go the other way and you lose money, or vice versa, where you think it's at the low, but it's really at the high, and then the market peels back, and then you are a bag holder waiting to recoup your funds. I wish everybody the best. Again, this is just a short educational video on some of the terminology and some of the things that you can do within the marketplace. I hope this helps you guys out. And that's about all the time I have again today. Thank you guys so much for stopping in week over week, liking and subscribing to the channel, and I will catch you guys again. Peace.